Sectoral indices are crucial for understanding the performance of different segments of the Indian economy. They provide a snapshot of how specific sectors are doing, which can be incredibly useful for investors, analysts, and anyone interested in the financial landscape. In India, the National Stock Exchange, or NSE, has several key sectoral indices that track various industries, from banking to pharmaceuticals to information technology. Let's dive into some of the major sectoral indices. The Nifty Bank Index, for instance, is a barometer for the banking sector. It includes the most liquid and large cap banking stocks listed on the NSE. When the Nifty Bank Index rises, it often indicates a healthy banking sector, which can signal increased lending and economic growth. Conversely, a decline might suggest tightening credit conditions or economic uncertainty. Next, we have the Nifty IT Index, which represents the information technology sector. This sector has been a powerhouse for India, contributing significantly to the country's GDP and employment. The Nifty IT Index includes major players like TCS, Infosys, and Wipro. A strong performance in this index often reflects global demand for IT services and software solutions, which is critical in our increasingly digital world. The Nifty Pharma Index is another important one. It tracks the performance of pharmaceutical companies, which play a vital role in healthcare. Given the global focus on health, especially post pandemic, the pharmaceutical sector has gained attention. Investors often look at this index to gauge the health of the healthcare industry and its potential for growth, especially with innovations in drug development and biotechnology. Then there's the Nifty FMCG Index, which includes fast moving consumer goods companies. This sector is essential because it reflects consumer spending habits. When the FMCG index is performing well, it usually indicates that consumers are confident and willing to spend, which is a positive sign for the overall economy. Companies like Hindustan Unilever and ITC are key players here, and their performance can be a leading indicator of economic health. Now, let's not forget the Nifty Auto Index, which tracks the automobile sector. This index is particularly sensitive to economic cycles. When the economy is booming, people are more likely to buy cars and motorcycles, leading to a rise in this index. However, during downturns, the auto sector often feels the pinch first, making it a useful gauge for economic sentiment. Understanding these sectoral indices helps investors make informed decisions. By analyzing trends and performance in these sectors, they can identify opportunities and risks. For instance, if the IT sector is booming, it might be a good time to invest in tech stocks. On the other hand, if the FMCG index is declining, it could signal a shift in consumer behavior that investors should be wary of. In summary, sectoral indices are more than just numbers. They tell a story about the economy and its various components. By keeping an eye on these indices, you can gain insights into market trends, consumer behavior, and overall economic health. Whether you're an investor or just someone interested in the financial world, understanding these indices can provide a clearer picture of what's happening in India's economy.